Good morning, everyone. My name is Samson John. I will welcome you today to the 3 days free training on forex trading, and I want to especially welcome every one of you who made it to this free training. And I'm sure that at the end of this free training, you will be grateful that you attend this particular training. I'm so happy to meet every one of you. Thank you so much for the privilege given to me to actually talk to you about forex. And I'm sure that at the end of it, you will find a reason to trade the biggest financial market in the world. Like I said in the introductory video, this 3 days free training has been designed and organized to help you become a more successful trader. Today we're going to be talking about introduction to forex, and we're going to be talking about what is forex. We're going to talk about the forex market, currency traded in the forex market. We're also going to be talking about forex technologies and also forex trading time. This is what we'll do today, and at the end of today you will be introduced to the forex market. You will know everything that you need to know about the forex market. But I will also encourage you not to all depend on what I just share with you here. I think I'm just introducing it to you. So I expect you to take out time to also research on your own, to build on your knowledge, not to have the same system that we got from the university where the lecturers just teach us something and we remain with just what the lecturer has taught us. But this time around is different, because your knowledge of the forex market is your competitive advantage to be successful in the forex market. So the more knowledge you have, the more likely you will be successful in the forex market. Another thing I also want to share with you is the desire to treat forex more than just a quick money making machine, because it's not actually a quick money making machine, but it's more like a business. It's a business, and you have to nurture it. You have to learn about the business first before you will begin to invest into the business. So I want you to treat forex like a business. Don't treat it like one Ponzi scheme. It's not a Ponzi scheme. Forex is the biggest financial market in the world, and I expect you to do as much. So without wasting much of your time, let's go into the business of the day. So what is actually forex? You see, forex is the exchange of currencies. It's the exchange of currencies of one country with another. So when one currency is exchanged between countries, it's referred to as forex. It's also known as foreign exchange, where one country exchange its currency with another country at an agreed mutual rate. So let's check in Google and check and look at what Google tells us about what is forex. Let's look at it. So from the Google, let's look at what Google tells us about what is forex, so that we'll have a broader, more large experience about what forex is. Because in Rain's FS Academy, we don't just give you what we want you to know, we give you what is relevant in the world. What is forex? So let's just discuss what is forex and ask Google about it. So these are the search results. They're about to just come out. So let's talk about what is forex. This Baby Peace. Actually, Baby Peace is one of the best sites where you can get information about forex. It's a very reliable site. Now, on the question what is forex, it said forex is quite simple. It's the global market that allowed one to trade two currencies against each other. So this is what they said. They said if you have ever traveled to another country, you see, you usually have to find a currency to exchange both at the airport, and then exchange the money you have in your wallet into the currency of another of the country you are visiting. So that is actually, good morning, that is actually forex. So that is actually forex, and forex is just the exchange of one currency of one country with that of another. So that is what forex is. So when you exchange a currency of one particular country with another, you are actually trading forex. And then when you have euro and you go to that aboki man to exchange your euro with naira, or you want to give him naira to get euro, what you're actually doing is forex. You are exchanging currencies and you are exchanging this currency locally. So that is what forex is. So what is the forex market? The forex market is the market where we exchange these currencies. But rather than doing that locally or physically, in this time around the forex market, we do that on the electronic platforms. That means we do that online. So we don't actually trade forex physically, but it's online, it's electronically. And this market has been there for years before now. Before now, individuals cannot actually trade forex. It is left for only the big banks to actually trade forex. But now, it has been brought to a very low level where individuals can actually trade forex. So the forex market is done electronically, is done online. That's why you need a smartphone or a laptop to actually trade the forex market. So let's look at Google again and find out what that will tell us about what the forex market is. Just hold on a little, and okay, you see, as I said, foreign exchange market is also known as forex market. This is actually where we exchange these currencies. We exchange currencies of one country to another. Let's look at what this particular is said. What is foreign exchange market? The foreign exchange market is also known as forex. Are you seeing, or FX, or what is special as currency market? And is an over-the-counter, that means OTC global marketplace that determines the exchange rate of currencies around the world. Participants are able to buy and sell and exchange and speculate on currencies. Foreign exchange markets are made of banks, forex dealers, commercial companies, central banks, investment management firms, hedge funds, retail forex dealers, and investors. You see, so this forex market, it has been for big banks before now, but right now they have made it so easy for us as individuals that we can actually trade in this market. And imagine that we can actually trade this market with as little as $30, $10, depending on how much you are actually willing to invest. You can invest 50 million, you can invest any amount, because the forex market is so reliable. It's so reliable. And apart from it being so reliable, is that it's so flexible, so that you can just sit on your bed and trade the market and make some few dollars and you're out of the trade. So that is what actually forex market is. That's what forex market is. And then apart from that, also we will be looking at currency traded in the forex market. Now there are several currencies that are traded in this forex market, such as, let me show you some example of some of the currencies that are traded in the forex market. Like the major currencies that are traded in the forex market, we have these are the major currencies that are traded in the forex market. We have the USD, that is the United States dollar, and then we have the European, we have the pound, we have the France, we have the Australian dollar, we have the New Zealand dollar, we have the Canadian dollar, the South African dollar, Singapore, and the rest of them. Almost there are several currencies that are traded in this forex market, but these are the major currencies that are traded in the forex market. And these currencies are always traded in pairs. They are not traded like one. No, they are always traded in pairs. Either you're buying one or you're selling the other one. So they are traded in pairs, and that is it. So let's look at Google again to check out to confirm this information. Now it talks about the most the 6 most popular currencies traded in the market. Let's look at that. Let's look at those. You see, forex is the largest and the most lucrative market, with over 5.3 trillion dollars are traded every day in the forex market. Let's look at the 6 major currencies traded in the forex market. We have the US dollar, we have the euro, we also have the Japanese yen, we have the Great Britain, we have the Canadian dollar, we have the Swiss francs, and more other currencies that are traded there in the forex market. So these are the major currencies that are traded in the forex market. And remember, like I said that these currencies are traded in pairs, and there are several of them, but you can't just begin to trade all the currencies. You must just find some major ones that you want to trade in the market, and that's what we actually do. We trade the major currencies that we look out for to trade in the forex market. So that's how we trade. So look at it, I'm into a trade actually, and my trade is about to hit my take profit. So I believe I can actually extend this thing here, extend it a little, and then bring my stop loss to even. Let's see, I want to bring it to even and take profit. So I'm actually in profit right now, and I'm bringing my stop loss to even so that I can actually capture more if I choose to. I can capture more. So let's look at it and see what I'm actually $6. I'm making about $6 right now. So I think it's a good trade. So I can actually move this downward since I'm in profit. So let's just see how I can control this market to actually move to a very long place. So let's see. So let's actually go back to what we were discussing before now. So I was talking about the currencies traded in the forex market. So these are they, and I expect you to actually choose your own and trade in the forex market, because that will give you a more advantage and a more better return when you choose pairs that you want to trade in the forex market. So that's that for this class. And then another one we're going to be talking about is forex terminologies. Now there are several forex terminologies that you will need to know, because like in every other business, there are terminologies that we actually use in the forex market. One of the terminologies that you can actually use in the forex market is the bullish market. We categorize, we said that we try to determine what type of market structure do we have right now. We have something like the bullish, we have something like bearish, we have something like pips, orders, stop loss, take profit, trends, indicators, and oscillators. Now bullish, when we said that the market is bullish, that means we are saying that buyers are more in control of the market. So when someone said, oh, the market is bullish, what we mean is that buyers are more in control of this market at the time. And then when we said the market is bearish, we are actually saying that sellers are in control. We are saying that sellers are in control of this market. So when we say look for a bullish market, what we are actually saying is look for a market where buyers are in control. And when you hear the word bearish, we are saying that look for a market where sellers are in control. Like, let's look at this particular market right now. This market is in the bearish market because it came from the bullish. You see, the bullish is upward. When it's trending upward, we said it's a bullish market. When it's trending downward, we said the market is a bearish market, because sellers are in control. Right now, buyers are in control. When you look at this point, buyers are in control of this market. Is a bullish market. But when you look at it from here, we said that this market is a bearish market from here. Is a bearish market from here. So that is how we determine the market structures. That's how we determine the market structures in the forex market. I think let me just bring this here and take profit, since I'm in this market. Let me just bring it here and take profit around here. Let me just bring it here and take profit around here once this gets here. because it seems like we are in a horizontal level and it will take time for this to actually break. Or let me just take profit when it reaches this point back again. So that is how we trade the forex market. So that's how we trade the forex market. We trade them in pairs, and that is that for that. So let's look at from Google and look at the bullish market. So let's look at the bullish market from here and see what Google will tell us about the bullish market. So we're talking about the bullish market. Now let's look at the bull market. Now it said that a bull market is a market condition in which prices are rising and are expected to rise. The term bull market is often used to refer to the stock market, but can be applied to anything that is traded, such as the bonds, real estate, currency, commodities, and all of that. So when you hear the word bull market, we are expecting that prices are rising, so buyers are in control of that particular market. So that is what the bull market is. So let's look at what the bearish market is from here also. We're talking about the bearish market. Now we said that, remember where I said about the bearish market? I said the bearish market is the market where sellers are in control, where we are expecting that prices are going down. The bear market is when the market experiences a prolonged price declining. So when the price is declining, we said that the sellers are in control, and that market is a bearish market. So that is how we talk in the forex market. One, pips. Pips are referred as point interest point. Now monies are made in pips in the forex market. Every little small movement in the forex market are referred to as pips. So when you hear the word pips, we said, okay, put your stop loss 5 pips away, 10 pips away, 20 pips away. Now what we're referring to is that we're saying that put your stop loss as some certain movement in the price in the market, whether downward or upward. So pips are referred to as point interest points. Now the monies in the forex market are made in pips. So any little movement in the market is referred to as pips. So when you hear the word pips, we're referring to as movement in the market. Points. How many points did the market move? Someone said, oh, the market moves 35 points. The market moves 100 points. It's all dependent on you to actually tell how many points the market moves. Says, oh, the market moves 60 points. The market moves 100 points. The market moves wherever points that the market moves. So we can actually check that. So from there we will also, I just made $6. I just went out of the trade because I don't like the volatility, so I'll be waiting for the next break out of this level. And then remember, I told you my trade is very simple. I just take break and retest of horizontal levels. Like here right now is another horizontal level right now, so I'm expecting it once it breaks this level, and begin to show me that bearish pressure, I will just take a sell again to capture. Now I was looking at some certain other currencies. Look at this. I was looking at this. I was also looking at this particular market too, and then I was looking at this to actually reach and give me that pullback, that rejection from here, and then I would just take I was looking at it. I needed a rejection. I needed this to reject this price. So once it begins to reject, I would just take a buy from that level. So I was looking at all these currencies then, and then this is what I actually came up with. let me look at this again. I'm also looking at this. So you see it actually reaches this point, and I'm expecting it to break. When it breaks to this point and give me that rejection out of this market, I will just take a profit from there, and then we will go. So that's that. We're talking about the bearish market, and we said that the bearish market is the market where the sellers are in control of that particular market. Now imagine in this just little class while we're talking, I've made about $6 to $7 just right now. So I think the forex is the biggest place you can ever, this is the biggest market you can ever trade. You can actually make money per seconds. In less than just about 15 to 30 minutes I make such an amount. This is impressive. And that, so pips are actually interest points. Now let's look at what pips stands for from Google, and try to also explain that what does pips stands for. Now let's look at them. Let's look at pips. Let's look at pips. Let's look at pips. Sorry, the network is actually very low, so let's just leave that until when it loads. We'll check it again. So we said that pips are point interest points, and I said that the movement in the market are categorized as pips. So a little movement in the market is referred to as pips. So that is what pips stands for. So when we say what is pips, we said that pips is a point interest point. So right now, so when you talk about pips in the market, you are not trying to say that maybe someone will ask you what pips is. No, nobody is asking you what pips is. You are only going to be conversant with these things, because these are the things that will guide you when you're trading. Now we're talking about orders. Now in the market, just like how not every market is, people make orders. People come and say, I want to buy this, I want to buy that, I want to buy this. So that is how the market is also is. People make order. Now such as we have naturally, you can make something like a buy. You can make a buy, instant buy. You can say, okay, I want to buy this thing right now, I want to buy this, and then you get the money. So that in the forex market is referred to as instant execution. Now we also have pending executions, so that you can just say, okay, when this price reaches this particular level, when this price reaches this particular level, I want to take a buy. Let me show you from here, for example, so that you can actually understand what I'm trying to say more. Now look at it, look at it from here. Look at this market from here. Now when you go here, this is actually where you can execute your trade. Now look at it from here. You see we have instant execution, isn't it? Now when you said instant execution, that means I want to execute this market right now. That is market executions. You want instant. Say, okay, I want to execute this market right now. Now we also have pending orders. Now when you come to pending orders, that means you're saying that, okay, when this price reaches this particular level, maybe you said, okay, I want to buy this market once it reaches this level. So you can put a pending order saying that, hey, look, when this market reaches this level, I want to buy. So once the market reaches this level, the broker will just execute your order for you, like you have placed an order pending that once this market reaches this point, I want to buy. So you can actually put such kind of orders in the forex market. And you can also do something that is referred to as sell execution, like buy limit. We have buy stops, we have sell stop, we have buy stop limit, we have sell stop limit, all of that. So when you say buy, remember you are anticipating that the market will go up, and when you say sell, you are anticipating that this market will go down. So these are the orders we have in the forex market. Those of you that have phones and don't have laptops, it's still the same thing. We will actually do that on phone. I will do that on phone and also add it to this video at the end of that, so that you can also see it on the phone. But all that you have here on the metaphor is the same thing you will have in your phones too. So and that's that for orders. We have stop loss. Now, stop loss are risk management mechanisms. They are risk management tools that we use in the market to actually help us to determine levels where we could say, okay, once this market reaches this plus take profit, when this reaches this point, stop my loss. So these are the risk management mechanisms that we use in the forex market to control your risks, because the forex market is a very volatile market and is very, very risky. So you must use every tools to ensure that that you place the right mechanism in place to ensure that you reduce your level of losses. You reduce your level of losses, and one of the ways to actually do that is by putting all these mechanisms, stop loss and take profit. But you must also learn how to control your stop loss, because you can determine and analyze the market so well, but because your stop loss are so tight, then eventually you find out that the market hits your stop loss and it begins to move downward again. Maybe in this market, if I put my stop loss somewhere here, and then I'm expecting that this market will go down, eventually the market might have gone down itself truly. But the beautiful thing is that if my stop loss is so tight, it's possible for the market to just go hit my stop loss and then begins to come down. So you must learn how to control your stop loss, how to apply your stop loss, and then you might pull your take profit too wide, so that you maybe pull your take profit somewhere around here, and then you are not so experienced to understand that this market will take a long time before reaching here. Imagine I put my stop loss, my take profit somewhere here. If you observe before, I put it somewhere thinking that the market will move down, but when I noticed that there will be a lot of rejection in the market, what I did, why did I expect a rejection? Because this particular area has been respected severally. Look at it. It has been respected severally. Price reaches this area and begin to go up. It reaches here and it begins to come down. Are you seeing it? Now it reaches here, there's a pool of rejections down here, and it went up again. So I'm expecting that once price reaches this point, it will make a rejection. Why? Because everybody is looking at it in the market entirely. They are looking at the market and they are seeing it that when price reaches this point, it might reject. But the price can actually come down, but it will take a lot of time. So I just want to take this profit and just walk away. That's why I did that. So that's what you can use stop loss is. Stop loss helps you to stop your losses, to help you minimize your losses, while take profit also help you to take profit at the time where you want to take profit. Imagine that you just said, okay, I want to take profit around here. So you put your take profit here, and once this market goes against me and it reaches here, I want to stop my losses. So you control your losses and also control your gains. So with this, I believe that the forex market will not become that too difficult for you to understand, because you can actually control anything that you want to do. So that is what about take profit and stop loss stands for. Another thing I said we're going to be talking about is trends. Now, trends in the market refers to as the movement, the direction by which the market is going. So if the market is going upwards, we said that the market is in an uptrend. When the market is going downwards, we said that the market is in a downtrend. Let's look at another market. Let's look at this. The market is in an uptrend and right now it's pulling upwards. Can you see it now? Now this market also, look at this. This market is also in an uptrend and the market is pulling upward, but now it's making a downward structure, a kind of a downward structure like kind of thing. Now imagine that this particular market reaches around here and it bounces. Now what I want to see is, I want to see a rejection. I want to see a rejection where the price can move upward, maybe touch here and then give me that also rejection. Then I will take a sell again, because I know that this market will eventually go down. So that is it. This market is an uptrend and there is a break of that trend downward. So we said that the market is in a downtrend right now and the market here is in an uptrend. So the direction by which the market moves is what is referred to as trend. So when you come into the market and you see the market is trending upward, we said, okay, the market is trending upward. Now when you come into the market and you see that the thing is making some kind of downward look of a kind of thing, we said that the market is in a downtrend. So that is what trends are all about. Now indicators. Now indicators are tools that we use to actually further determine our markets, to determine market structures. Like when you want to impute indicators, come in here, you see indicators. There are several indicators. We have trend indicators such as moving averages, Bollinger Bands, Ikamuche, parabolic standard deviation, and all of that. And we have oscillators. Actually, the oscillators are trend following. Oscillators are momentum. They are momentum following tools. They are momentum following tools, so that they try to determine overbought and oversold areas. So when you're using something like MACD, the moving average conversion divergence, that is the MACD. This is moving average conversion divergence. So we use that actually to determine momentum, to determine whether the market is overbought or oversold. Let me give you, for example, if I put a 12 moving average exponential, we have exponential moving average, that is 12, and then we have the simple moving average to be 9. Now when you look at it, this particular, it produced this particular kind of graph. Now when you look at it, this market tells me overbought and oversold areas. Now you see that when the market goes above here, when it's here, we said that the market is trending upward. So when the graphs are formed below, it's trending downward. Now look at it. Now from here you can actually determine the trend of the market. You can say, oh, the market is trending downward, upwards. And then when you look at here, you said the market is trending downward. Now this market also helps you to determine overbought and oversold areas. Now look at it. Like when you observe here right now, you see that the red line, the exponential, the simple moving average red line is crossing above the graph. That means around here we actually have an oversold areas, overbought areas. Now look at it here. So once you have an overbought areas, you wouldn't want to buy. Why? Because people have overbought this particular material. People have overbought this particular thing that you want to buy. So at that point, because people have overbought it, if you said you want to buy it, you're going to be making losses, because people have overbought it. Now remember when we talked about demand and supply in economics, we said that when demand oversees supply, that means that there will be increase in price, isn't it? And when supply oversees demand, there will be reduction in price. Now look at it. There's a supply of higher prices around here, and the demand is very low. So what do you expect? Price will fall down, and that's what happened here. So price fell down. So that is what indicators can do for you. And indicators uses past historical events. Indicators try to use what happened in the past to try to predict the future. So that is what indicators are used in the market, and you can actually put them through this particular place. We have oscillators. Oscillators determine overbought. They are momentum following tools. They try to tell you overbought and oversold areas. And there we have what we refer to as relative strength index. We have MACD. We have force index. We have a lot of them. A lot of them sarcastic oscillators. A lot of them, we have them that we can actually use to further predict the movement of our market. But normally, me personally, I don't use any of these indicators. The only indicators I use is actually Ikamuche. I use Ikamuche and moving averages to actually further tell the direction of my market. So that is what I actually use in the market. So that is all about indicators and oscillators. Now a little recap of what we did today. We talked about what is forex. We talked about forex market. We talked about currency traded in the forex market. Then we talked about forex terminologies. Now we're going to be talking about forex times. Now the forex market is traded 24 hours a day and 5 days a week. Now the market has no time. It's traded 24 hours. Any time you come, the market is open. And we have particularly 4 types of markets. We have the Sendiki, we have the Tokyo, we have the London, and we have the New York market. That means that the Sendiki or whatever, the Sendiki market opens around 11 p.m. on Sunday, and then closes around 5 p.m. on Monday. but Tokyo market will open around 11 p.m. This is 9 p.m. actually. It opens around 9 p.m. and then the Tokyo market will open around 11 p.m. and close around 7 p.m. Now immediately 7 p.m. when the Tokyo market is closing, the New York market will open. So there is an interchange. There is an interchange session in between them. That makes the market 24 hours a day. So you see, it covers the whole day. So every day, whether any time you wake up, you will meet the market and the market will always be open. So the markets are traded 24 hours a day. So there is no need of you to actually try to determine which market is trending. But as a forex, the more you advance in the forex market, you will just know within yourself, you will know within yourself that okay, the market is we are in the London session, we are in the New York session, Tokyo or syndicate session, whatever section we are in. But there are actually more momentum in the London and the New York session. There are actually larger momentum in the New York and in the London and New York session. So that's that about the currencies, the trading times in the market. So a little recap of what we did. We talked about what is forex. We said that forex is also known as foreign exchange. It's a market where we exchange one country exchange its currency with another. And we talked about currency traded. We said that there are several currencies that are traded in the market, but there are majorly 16 of them actually in pairs. And we said that these currencies are traded in pairs. So that's that for that. And we'll also talk about forex technologies, where we talked about under forex technologies. That's where we talked about under forex technologies. That's where we talked about pips. We talked about pips. We talked about pips. We talked about pips. We talked about orders. We talked about stop loss. We talked about indicators. We talked about trend lines. We talked about oscillators and the rest of them. So under that market, that's what we talked about there, and I'm sure that you enjoy every bit of it. So I will expect you to actually go back and look at this video, listen to them again and again and again, and then find a better place where you can actually develop more of your knowledge. Remember, I told you that you don't just depend on what I've just taught you, but you can actually build more on your knowledge of the forex market. That sound is made actually from my trading account. So let's